Index fund investing is usually seen as the best and safest way to grow your wealth over time. Just buy, hold, and let the market handle everything else. While index funds do most of the work for you, there are still a few surprising flaws that could mess up your long-term success. Let me show you what those are because they could quietly chip away at your returns over time. You might think that you're doing everything right, but sometimes it's the small, unintentional moves that cause the greatest damage. As always, when I say index funds throughout this video, I'm referring to traditional index funds as well as index fund-based ETFs. One of the greatest strengths of index fund investing is its simplicity. In a time where the financial world can feel overwhelming with endless choices, strategies, and opinions, index funds eliminate the noise. They offer a straightforward approach. Track a market index, keep costs low, and let time work in your favor. There's no need to pick individual stocks or worry about beating the market. Index funds allow you to capture the overall performance of the market with the minimal number of funds. This simple, passive approach is what makes index fund investing so appealing to both new and experienced investors. You don't need to be an expert or have an in-depth understanding of every stock out there. The beauty of simplicity in index fund investing is that it frees you from the stress of constantly having to monitor, tweak, or adjust your investments. By sticking to this straightforward approach, you can focus on the long-term game and let the market do the work for you. That way you can go do more productive things that you've been putting off for far too long, like scrub your toilets or clean that gross microwave of yours, or pick up all of the random things around your house because it's starting to become a mess and you're starting to look like a hoarder. But just because index funds are designed to be simple through buying and holding doesn't erase the threat of feeling like you need to be doing more. People watching is one of my favorite things to do, specifically in a setting where they're waiting for something. So like a doctor's office, waiting in line to get into a concert, or the BMV. It's very rare to see anyone in these settings who doesn't pull out their phone to start playing on it, because no one can sit still and do nothing. There's this inherent gravitational pull to feel like we need to do something instead of just sitting there with our own thoughts. It's the same idea with investing in index funds. We live in a world where we're constantly told to take action, stay on top of things, and tweak our strategies to get the best results. Oh my gosh, everybody, warning, the Federal Reserve is going to increase or decrease interest rates. Prepare your investments now. If this president wins, the stock market is definitely going down. Sell everything before it happens. The stock market has been up too much for too long over the past 12 years, so it's definitely due for a correction. You better do something about it. Everybody and their brother just wants us to react to every single freaking thing happening on a week-to-week basis. And if we don't, well, good luck with that, because you're going to lose all of your money and become a poor person. When it comes to index fund investing, the mindset of always needing to react can be extremely counterproductive. Index funds thrive on the buy and hold strategy. The idea is to invest consistently over time, leave your money in the market, and let it grow. But many investors make the mistake of thinking that they need to check their portfolio regularly, add additional funds, adjust their holdings, or jump in and out of the market based on the latest headline. Constantly feeling this need to do something often leads to poor decisions. The funny thing is that doing less is often what leads to better outcomes with index funds. Every time you make a move, whether it's buying, selling, or shifting your allocations, you run the risk of losing out on gains, or worse, timing the market poorly. Here are just a few reasons since 1970 that an index fund investor would have thought that they needed to react to what was going on in the world. Trying to predict most of these events ahead of time was nearly impossible. The good news is that you don't need to be an expert or time anything correctly. You just need to stay in the market, even when everything looks like it's going to hell in a handbasket. History shows that the longer you are invested, the better your chances of seeing growth. So resist the urge to overmanage your investments. Sometimes the best action is no action at all. Let the simplicity of index funds do the work for you, and remember that the power of this strategy lies in patience, not constant activity. Help support my little dog Molly as well as this channel by hitting that like button. Another flaw of index fund investing is if everyone does it. To weirdos like me, this sounds like a dream scenario. Everyone buys broad-based, globally diversified index funds, then plays in the woods with their dogs for the rest of their day. But to be honest, that would mess up the whole stock market. Since index funds buy at whatever current prices are no matter what, They don't set prices for all of the individual stocks held within the fund. They just track them. Active investors, people who buy and sell individual stocks based on research and analysis, are the ones who help the market determine the fair value of each company's stock. Unlike us index fund investors, these active investors actually care about what they buy and sell something for, since they're actively trying to beat the market and make money. This process is called price discovery, and it's absolutely critical to how the stock market functions. Without active investors participating on a daily basis, the prices of stocks would stop adjusting in an efficient way to new information like earnings reports, new products, or changes in the market. If they weren't out there doing what they do, the market would actually become less efficient and index funds would start tracking prices that were way out of whack, which could lead to long-term problems for all investors. In other words, index fund investors need active investors just as much as active investors need the stock market. While index funds provide us with an easy, low-cost way to invest, they rely on active investors to keep the market running smoothly. If everyone became an index fund investor, the balance would be thrown off. I love poking fun at actively managed funds as much as everyone else because most of them constantly underperform index funds. But I am secretly happy that those degenerate people exist. Do I think they're ripping off their investors with how much they charge? Absolutely. But at the end of the day, there are always going to be suckers in this world willing to play a losing game in hopes of hitting it big, even if the odds aren't in their favor. Heck, that's why we see so many people continue to play the lottery. Someone has to pay the stupid high fees that these funds charge, and it ain't gonna be me, and hopefully not you either. So while index fund investing is a great strategy for most people, the market needs a mix of both active and passive investors for a healthy balance. Just like every Batman needs a Joker, every Cartman needs a Daywalker, and every thug needs a lady. Only Alkaline Trio fans will understand that last reference, which is probably 0% of you watching this. Another potential flaw of index fund investing that many people don't think about is proxy voting. When you invest in an index fund from companies like Vanguard, BlackRock, or State Street, you're not just buying shares, you're also giving these fund managers the ability to vote on your behalf in corporate decisions for all of the companies held within the fund. And while that might seem harmless at first, it could be problematic depending on how these companies choose to vote. As a shareholder, you technically have the right to vote on key issues within companies you own. But since most of us invest in funds that hold thousands of stocks, keeping track of those votes would be nearly impossible. So what happens instead? The fund company like Vanguard or BlackRock cast proxy votes on your behalf for each company within the fund. This includes votes on corporate governance, executive compensation, ESG, and even DEI policies. Here's the problem. Most investors don't have control over how these votes are cast, and the fund company may not always vote in ways that align with your personal values or financial goals. While proxy voting can be convenient for investors like us who don't have the time or expertise to weigh in on these decisions, it also raises questions about whether these fund companies are truly representing your interests. Vanguard, BlackRock, and State Street hold enormous influence, and how they vote can have a huge impact on corporate decisions across the market. I did a video last year on the findings from a report on how these fund companies vote on topics like ESG because they don't all align. Vanguard was the only one that chose to take a more rational approach towards how they vote. They clearly state, "We take a principles-based approach to investment stewardship, focusing on long-term value creation for Vanguard-advised funds. We have no agenda beyond shareholder return, period." As a Vanguard fund investor and someone who cannot stand that whole ESG, DEI grift, this is exactly how I want them to vote. Now, BlackRock and State Street, on the other hand, seem to have different agendas. Some fund companies are now experimenting with giving investors a say in how their shares are voted. Vanguard, for instance, is piloting a program that allows certain investors to cast their own votes. But the reality is that most people don't have a desire to vote, so we're leaving it up to those massive institutions to control the votes, and in turn, influence the direction of the companies we're investing in. Since people like myself talk positively about index funds, it could give off the illusion that they're somehow safe or risk-free investments. After all, they're diversified, they track the entire market, and they've performed well over the long term. But here's the reality. While index funds can reduce certain risks, they're not immune to risks altogether. Index funds still reflect the performance of the market and market fluctuations. If the market drops, your index funds will drop right along with it. These funds are designed to track the market, not beat it or avoid its losses. During a downturn or recession, an index fund will follow the same downward trend as the broader market. None of us will escape the volatility just because it's an index fund. Even though these downturns might not last that long in the grand scheme of things, experiencing them in real time can be emotionally and financially draining. While index funds are great tools for diversification and long-term growth, they're not a guarantee against short-term or even long-term losses. That's why it's important to understand your own risk tolerance, investment goals, and the time horizon that you're working with. Assuming that index funds are a safe bet for everyone without understanding the risk could lead to a rude awakening when the market takes a turn. Index fund investing also isn't going to shield you from another threat, which is assuming that anyone you pick is going to be perfect for your needs because it's called an index fund. You might hear the term index fund and automatically think of something like the S&P 500 or a total stock fund. But the reality is that index funds can track a wide variety of markets, sectors, or asset types. If you're not careful, you might end up investing in an index fund that doesn't align with your specific goals. For instance, let's say you're aiming for broad diversification and long-term growth. If you mistakenly invest in a sector-specific index fund, like one that's focused on tech or healthcare, you're now heavily concentrated in one area of the market. That can introduce a lot more volatility and risk that you might not be comfortable with. On the other hand, if you're looking for steady, conservative returns, but you accidentally invest in an index fund that tracks small cap companies, you're likely going to see higher volatility and possibly lower returns during certain periods of time. This mismatch between your investment and your goals can leave you exposed to risks that you did not intend to take. Another important factor is choosing index funds based on your stage of life. If you're early on in your career and have decades of investing ahead, you might be more focused on growth-oriented funds like tracking the S&P 500 or even small cap indexes. At this stage, you have more time to ride out market fluctuations and benefit from higher potential returns. However, if you're nearing retirement, your needs are usually going to be different. You might prefer index funds that offer stability and income, such as ones tracking bonds or dividend-paying companies. Choosing the wrong index for your stage of life could mean either taking on too much risk when you need to protect your savings or not capturing enough growth when you have time on your side. It's also important to consider geographic exposure. Some index funds focus on international markets while others track US-based companies. If you are looking to invest in a global portfolio but accidentally choose a fund that only focuses on US companies, you could be missing out on growth opportunities elsewhere. The key takeaway here is that not all index funds are created equal. Each one serves a different purpose and tracks different segments of the market. Before you invest, make sure that the index fund you are choosing aligns with your personal finance goals, your risk tolerance, and your stage of life. Since a lot of this can be unnecessarily confusing, it's why I personally promote more broad-based index fund investing, like with a simple 2 or 3 fund portfolio, which you can learn more about in this playlist to your left next. Hit that like button before you go. I'll see you in the next one, friends. Done.